What's up you guys, Sasha here. We are living through completely unprecedented times. Never before have so many people sat at home worrying about their money in quite this way. Never before have so many people been on the brink of losing their jobs. Has the government been borrowing this much money? Have so many companies been in this much trouble? And yet here we are, the recession is only just starting to take hold. It is likely to continue through the rest of the year and beyond. What does this mean for the housing market? What is the potential impact? Let's talk about it. First, let's talk about the official predictions. The government, various publications, and most importantly, the experts are telling you that the housing market is going to dip this year, but then go and bounce back from 2021 onwards, and we are going to be in a much better place in just a few years' time. The official predictions, depending on which source you look at, will tell you that it's somewhere between 5 and 10%. Savills is often quoted as the expert in this case, and they tell you that the housing market will drop by 7.5%. Savills also tell you that then in the following few years the market will rebound so quickly that by just 2024 the market will be up over 15% after taking into account the dip in the first place, which means it will be rising more than 5% per year from next year onwards. So far there are no good official numbers you can look at. The Land Registry has only got numbers up to March, and in March there was a 0.2% drop in housing prices. But the major frustration is that all the news and media outlets are quoting experts who just happen to have a vested interest in a positive outlook on house prices. One of the most critical factors in any housing market is buyer confidence, and buyer confidence is driven by certainty, by wages, by being able to hold down a steady job. So let's just talk about some of the numbers that are emanating in the early months of this recession. 9.1 million people are currently on furlough. This number is staggering. This is an absolutely huge proportion of the UK workforce, which is currently being paid not by the companies they work for, but by the government. Many of these people are only earning 80% of their wages without them being topped up, despite the government encouraging businesses to do so, or lower. Many companies have forced voluntary drops in wages on people in order to make it through this period, and so a lot of people are earning considerably less than even that 80% mark. At the end of 2019, the UK had less than 1.3 million people unemployed and claiming some form of benefit. As the pandemic unfolded, in April, 850,000 people signed up for Universal Credit or Job Seekers Allowance, which took the total to 2.1 million. This is the biggest rise since records began in 1971. In May, this number is growing to 2.8 million, and we're not seeing any real signs that this growth is likely to slow down considerably in the coming months. In just the first 2 months of these numbers coming through, there's been a 126% rise in the number claiming unemployment. But more importantly than this, the official number for the average hours worked has dropped by 9%. And job vacancies have hit an all-time low, so the people that are currently unemployed who are looking for new jobs have absolutely nowhere to go. The really big issue is going to be coming later this year. Out of those 9 million people who are currently on furlough supported by the government, a huge number of them will not have a job to come back to. Companies are beginning to declare bankruptcies, going into administration. Other companies will choose not to continue employing people after the government stops support. A lot of people go through redundancy processes. Other people will just not have a job to go back to at the end of all this. So how much buyer confidence is that going to bring to the housing market for a rebound in 2021? The government has been propping up businesses to ensure that there is stability in the market and ensure that at least some of these companies that are going through a tough patch have a chance to survive. There's been 3 big lending schemes announced by the government for companies who are in this position, depending on the size of the company and the amount they wish to borrow, and through all of these, some £38.4 billion has been lent so far, and that number is rising very, very fast. The bounce back scheme, which lends up to £50,000, has benefited 864,000 companies with a total of 26 billion being lent out. With approval rates at 82%, a huge number of companies did get it, but what are the chances of them being able to pay it back when their businesses don't grow back at quite the same rate as they expected? The second program is the Coronavirus Business Interruption Loan Scheme, and that has had a 51% approval rate, which means 50,000 companies collected a total of 10 billion between them, but it also means that 50,000 companies didn't get anything. 279 large businesses have collected a total of almost 2 billion, bringing the total number of companies that have collected money from the government to almost 1 million. The first 12 months of these schemes do not require repayment, they don't require paying of interest, nothing is owed to the government during this period. But when the 12 months are up, all of these companies are going to have to start making monthly repayments on these debts from profits that they are hoping are going to come back. But how much more money can the UK government pump into the economy after this if this recession continues for months and months and possibly longer than that? Let's talk about the UK debt. In April, the UK government borrowed an additional £48.5 billion, an extremely sharp rise in borrowing which hasn't been seen since World War II, and in May this number went up another £55.2 billion. The first time in many years the UK debt has soared to more than 100% the size of the UK economy, and it is only going to grow from here. The rate at which it's rising is about the same as in the early months of World War II, just to put it into some kind of perspective. In the last financial crisis, the UK government bailed out several banks. This was a massive decision. There was a lot of controversy around whether they should or shouldn't have done it, and whether they should have done it in this particular way. But this time around, the numbers are considerably bigger. What happens when millions and millions more people go unemployed? What happens when a large proportion of these loans that the government has just dished out do not get repaid? Some analysts, think tanks, publications and media are saying that as many as 40 to 50% of the businesses that have borrowed money from the government are expected not to pay it back. So what does this mean for the ability of the UK government to support businesses, support people and support companies going forward if the situation continues beyond the end of this year? Banks have withdrawn a huge number of mortgage products. Almost everything that is offering 90% or 95% is no longer available. Now, if you want to get a mortgage, the process is incredibly difficult and you have to have a very, very large deposit in order to be able to get it. Consumer confidence begins to dip, and with millions of people becoming unemployed in the course of the next few months, the likelihood is that the consumer confidence in buying a property and being able to afford the mortgage is going to drop, as well as the banks not lending the money out in the first place. The official numbers will tell you that there's going to be a short-term drop of 7 to 10%, followed by a rise starting from next year, which is going to quickly bring the house prices back up to roughly what they were at the beginning of this year. But the last time we saw anything like the scale of the economic recession that is about to come, the recovery took many years and even decades. People are losing jobs, people are finding it very difficult to find new jobs. Those that still have their jobs are earning considerably less than they used to. And these are exactly the people that are supposed to buy the houses and sell the houses in order to keep the prices up, in order to keep the demand and the supply up, and ensure that there is confidence in the market. So let's just be real here. Let's brace ourselves. The housing market is very likely to crash, and it's likely to crash hard. If you're currently looking to buy a property, I would strongly consider having a think about whether that is the right move, whether the huge amount of money you're about to invest in the property is going to decrease in value considerably, whether the volatility is worth it, whether being able to rent for just a few months to see exactly how this pans out is actually a smart move right now. If you already own a house and are thinking of moving, again, it's probably wise to have a think about how urgent that move has to be and exactly what it means for your finances. It's not the best topic of conversation, but I felt that it was very, very important that we just cover some of the important aspects and what that's likely to mean for the housing market. If you found this interesting, please give this video a like so that more people have a chance of viewing it. If you enjoyed this kind of content, if you like talking about personal finance products, making more money and keeping more of the money that you do make sure you subscribe to this channel. I've got videos coming out every Monday, Wednesday and Friday where I talk about all of these topics. Make sure you hit the bell so you get notifications every time one of my videos comes out. I'll see you guys later.